Hey guys, welcome back to Toto Capital here. In this video, I'm going to break down two trade recaps, one on AUD/USD, one on CHF/JPY. These two trades alone netted over 12% on the week there, risking 2% per trade. So just to put things into perspective, if you're trading a 100,000 US dollar trading account there, funded account with FTMO or the likes of my forex funds, these two trades alone would have netted you over $12,000 there. Okay, on these two trades. So I'm just going to jump straight in, guys. I don't want to mess around too much here. So starting things off, this is AUD/USD, and this trade was closed out for a 3R. So if you risk 2% on this trade, you would have closed the trade with 6%. And, on a $100,000 funded account, that is a profit of over $6,000 there. Okay, so let's jump straight into this. Let's rewind this back and really show you guys this sort of the intricate details of why this trade was taken. Okay, so we'll start things off here with the actual strategy. So the rules, number one is our break of structure. Okay, so we need to understand where the higher time frame flow is and where the institutions are most likely to take price. Okay, so number one, break of structure. Can we identify that first mechanical rule-based concept there? So number one, let's mark that on. So certainly you can see here that we have violated structure to the downside. We have broke structure to the downside, indicated by this strong move here, this strong bearish push to the downside. So we can go ahead and mark on our BOS to the downside there, break of structure. This indicates to us that the sellers are in control of this market, and therefore we should only be looking for shorts on this market, on AUD/USD. Another thing to note, this is the 4-hour time frame. So, it may take some time for these trades to play out. So you're not going to be in and out within sort of 5-10 minutes. These are you're gonna hold it over the day, over a few days, depending on how quick price actually plays out there. Okay, number two, we can mark on our POI, our point of interest. Okay, so once we've identified the break of structure, we can go ahead and mark on our GH, which is our guarded high. Okay, so this is our invalidation level. If price comes back up and closes above here, that would invalidate our short bias, and therefore we would no longer be interested in looking at shorts on this market. Okay, so number two is our POI, and the POI is the last up candle before the break of structure. So POI is our point of interest. If and only if price comes back to this area, then we would be looking for a short trade. Okay, and we draw this on at the order block. So the order block is the last up candle. That's this candle here before the push to the downside. You can see that price aggressively moved to the upside before then selling off. That's a good sign to us as traders that this has some sort of inducement in the markets. Okay, so the institutions have essentially created a trap for the retail traders by pumping up price aggressively, trapping traders long, and then instantly shifting price to the downside. Okay, so that's our POI, the last up candle. Because this candle here is very large and our POI is very large, what I want to mark on is a 50% mitigation of this order block. And what I mean by that is we can draw on a fib retracement from the open to the high of that candle, and 50% of that mitigation would be 50% of that zone there. So if and only if price comes back to 50% of this mitigated order block, then I'll be looking at taking shorts on this market. So that's just a quick sort of tip. If your order block is very large, which this one is, you want to refine it down a little bit, but still where you're not refining too much, because you see traders where they're going to look to short, and they have this extremely refined order block, and in reality you're just really never going to get filled in the market, so you're going to miss a lot of trades. Okay, and also, you know, the probability of price literally just wicking that order, that sort of mitigation to the pip, and then having that very, very small stop loss, it just doesn't play out very well. Of course, that is something down to yourself, guys. So if you want to use, you know, a 50% mitigation, or if you just want to take it based off the actual order block itself, that's ultimately down to yourself. Okay, something you guys maybe want to test. Okay, number 3, we want to set a limit order at the order block. And in this example, we're using a 50% mitigation, so that's exactly where we're going to set our pending order. So we set that just below the 50% mitigation, stop loss above the guarded high, very important. So we have a very logical stop loss placed above the guarded high. So, you know, if price closes above here, or, you know, comes above this guarded high, that would indicate to us that the trend may be shifting into a bullish market. So that's why we have a stop loss above the guarded high. We have a mechanical stop loss and a very mechanical invalidation level. Targets are going to be at the low here, based at this low, and we're going to be looking for further continuation. Okay, so we're going to be targeting the liquidity, you know, equal lows to begin with, and ultimately further continuation. You can see there, you know, it's around a 1 to 3.4 at the lows there, so most of your positions just going to be coming off at these lows. Okay, because ultimately price can create a double bottom and then ultimately, you know, potentially push to the upside. So it's important to take a lot of your position off if the risk to reward makes sense, and just logically speaking, because price can of course reverse from these areas. Okay, so allow price to play out. We've got to be patient. You can see we sort of initially tap into our order block. Let's extend this across for you guys. Okay, extend that across there and extend that zone across. Okay, perfect. So you can see we sort of tapped into the order block. We had a small sort of reaction to begin with, and then ultimately we push higher here and we are filled on our short position there. So we're tapped in here just below. Stop loss was 30 pips. Target was just above the liquidity area here. Okay, so let's allow this trade to play out. We triggered in this trade. Allow that to play out there. Okay, and you can see TP was smashed at around a 1 to 3. I took off 80% at a 1 to 3 risk to reward, and then I was allowing some to run there. Okay, and you know, this is why it's very important, it's very crucial to make sure that you're taking off profits towards the low there, because as I said, price can reverse off the low, potentially making some sort of double bottom there, and then ultimately start pushing back to the upside. And it looks like, you know, this market's probably going to range sort of for the foreseeable, but you can see we're sort of chopping around now within that range there. So that's this trade on AUD USD. 1 to 3 risk to reward was pretty much bagged on this one, with a very logical stop loss there, in and out within, you know, you can see here we triggered in, it was 1:30 UK GMT time, where we're expecting volume to come into the markets there, and within, let's have a look here, within, you know, 2 days or so, this trade had already smashed take profit there. Okay, so just to put it in perspective again, you know, if you're on a 100,000 USD account, a funded account there, this trade would have netted you over $3,000 US. Okay, so that's AUD USD, and now let's jump on to CHF-JPY, another systematic trade that we took on this one. Okay, let's break this down step by step. I'm not going to sort of draw everything on again for this one, just for simplicity, but pretty much the strategy is the same. It's mechanical, right? So rule number 1, break of structure. You can see here we broke structure to the downside strongly. Let's play this back a little bit here. So you can see we broke structure there. So we have a low, here we have a lower high followed by a lower low. Strong break to the downside. Therefore, we are looking for number 2, which is a entry out of our POI, which is a limit order on the order block. Another thing to note here is this order block isn't too large like the other one, so we can just take a short position based on the order block, stop loss logical above our guarded high there, and then look to target this low and for further continuation, of course, targeting all of that liquidity below the lows there. Okay, so break, we're looking for price to come back. You can see we're tapped in, stop loss is intact there, and then this one played out pretty quickly, and I still have a small piece running on this one. You can see price ran around a 1 to 5 risk to reward. So as of right now, if you're risking 2% on this trade, 2% on this trade, that's up to 10% there, which is over 10,000 US dollars if you're trading a 100k USD account there. So yeah, that's the 2 trades that I took this week. This one, CHF JPY 4-hour time frame, and yeah, limit order on the order block, and then look for that continuation there, running them stops to the downside. Okay, so in summary, you don't really need to be taking too many trades. Quality over quantity. Follow your systematic approach. Whether you use my strategy or what have you, make sure that it's very mechanical, it's rule-based, and quantifiable. Okay, but yeah, let me know your thoughts in the comments below. I thought I'd take a slightly different approach with this video on the sort of trade recaps that I'm personally taking. Okay, but yeah, I'll see you guys in the next one. Take care, guys. Bye-bye.